Every client is different. I always say that, everyone has their own little tax puzzle. Typically in retirement, income drops, so you might find yourself in a lower tax bracket. This isn't always the case because other income sources might kick in, such as Social Security and taking your required minimum distributions. But one thing I see a lot of people getting kind of caught in a little surprise is actually paying in your taxes.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back, everyone. This week, we have a special guest, Laura Caiafa. Welcome, Laura.
Hi, Ryan. Thanks for having me on.
Thanks for coming on. And this week, we're going to talk about taxes in the first year of retirement. But before we do that, Laura, tell the listeners a little bit about yourself.
Sure. I'm an enrolled agent with Caiafa and Company. We're in Hamden. I just kicked off my 17th tax season. I have my undergrad in business management from Connecticut University and my master's in business administration from Southern. I'm a board member of the Connecticut Society of Enrolled Agents. I'm involved in a local networking group as a treasurer. The firm, we work both with individuals and businesses in a range of industries. We offer tax prep, accounting, and tax planning. We're big with tax planning, especially for our clients headed into retirement, as we're going to talk about today, and other major life changes. Yeah,
obviously retirement's one of the big ones.
Yep.
Just before we go into that, just a little bit about an enrolled agent. I know sometimes people aren't familiar with that. They think usually CPA. Talk a little bit about what that means.
Yeah, sure. Actually, in fact, CPAs are, I believe the percentage, it's only something like 1% of CPAs prepare taxes.
Oh, really?
Whereas enrolled agents, EAs that we go by, most of us are tax preparers. We're federally authorized by the Department of the Treasury. So we prepare taxes of all types, individuals, businesses, but we also can represent taxpayers before the IRS with tax issues that they might have. So, we do a lot of IRS representation here as well.
Sure. Yeah. Something that you don't want, but if you do, you want to have the right person representing you.
Yeah. The IRS is not always right.
Yes, true. So, I've had a number of clients over the years, obviously retire. That's what I help them to do. And I find that for some clients, when they go into that first year of retirement, they have some tax surprises because things definitely change, once you retire. Can you talk a little bit about what some of those changes that people can experience are?
Sure. Yeah. So, every client is different. I always say that, everyone has their own little tax puzzle. Typically in retirement, income drops, so you might find yourself in a lower tax bracket. This isn't always the case because other income sources might kick in, such as Social Security and taking your required minimum distributions. But one thing I see a lot of people getting kind of caught in a little surprise is actually paying in your taxes. So, a lot of people, they previously were a W-2 employee. They had withholding. They were paying in weekly. So in retirement, you might find yourself owing taxes when you go to file because you didn't pay in enough during the year as you normally would have in your week-to-week paycheck. So you'll hear me say this a lot in this segment, but tax planning is key.
Yeah, definitely. So like you said, when someone's working for a job, they usually have mandatory withholding. I mean, you have some choice over that. But when you retire, like for instance, a lot of people are receiving money out of their retirement accounts. They actually can choose to have zero tax withheld.
Yep.
So let's just say a client says, you know what, I'm going to settle the tax up when the taxes are due, and they have zero tax withheld. What is a pitfall that somebody could experience by doing that?
Yeah, it is something they can do. And we do have clients request that. They're just going to end up owing a large bucket. Well, maybe not a large bucket, but they'll owe money at the time that they file, which I think they expect. But what they don't expect is they're likely also going to get hit with something called an underpayment of tax penalty. So some people don't care. They'll say, all right, I'll pay the extra few $100s or in some cases, few $1,000s. I'll pay it. I don't care. I want to keep my money in my pocket through the year. But, we just let clients know this, you're going to be paying extra money essentially for no reason. So, either withhold or, we'll set you up with quarterly taxes so you can avoid the underpayment penalty.
Okay. So how does the IRS determine you owe an underpayment? What would trigger that?
Yeah. So really it's, the IRS wants their money evenly through the year. So an underpayment penalty is a fine that taxpayers could get if they don't pay enough tax in during the year or they pay late. Typically, if your balance due when you're filing your taxes is less than $1,000, you can avoid that underpayment penalty. But typically, if you owe more than the $1,000 as your balance due when you file, typically, if you didn't pay in enough during the year, you get hit with a certain penalty. And it goes by interest and the penalty. So I think it's something along the lines of 3% for 2021, but there is a certain calculation they use of what defines that actual amount of penalty.
Oh, so 3% is the interest you have to pay?
Yeah, yep.
Okay.
And I can, again, it's something I'll be truthful, our software typically, helps us out with, but the typical rule again is just when you're not paying enough during the year to cover yourself or you're paying late.
Yeah, I mean, and like you said, it's a free gift to the IRS, right? Why would you give someone a free gift of 3%? I mean, you're probably not leaving that money in your savings account right now and earning 3%. Maybe you could invest the money, and if you timed it right, you might earn more than that, but there's no guarantee of that. So probably to avoid that, you should pay the correct withholding or maybe pay estimated taxes, right?
Right. Yep, exactly. And again, I'll keep saying it, but how do you calculate that? That's where tax planning really helps you kind of figure out how to avoid the penalty and paying what you should be during the year to avoid that.
Okay. So one of the keys, it sounds like, is owing less than $1,000 to the federal government, right? That's one way to minimize the penalty, or?
Right. Well, that's one way. If that's the general rule as to when that penalty might kick in, if you hadn't paid in enough during the year. So basically, I can get into that too, but you have to pay in 100% of your prior year tax to avoid that penalty. So if you had a year where, last year, your prior year tax was $1,000, you didn't actually have a great year. This year, you had a huge year. You can pay in cover yourself for the minimum tax, and then you might still have a balance due of $20,000 come tax time, but you don't have a penalty because you actually paid in your prior year tax. Does that make sense?
So that prior year is key.
The prior year is key. Or your current year, you want to aim for 90% of your current year tax.
Okay.
So that's why retirement is, the first year of retirement especially, is kind of key to determining that, because some people might say, okay, I retired this year, so my taxes last year were way higher than they are this year, so I don't want to pay in my prior year tax. Well, that's fine. Then you pay in 90% of your current year tax. A lot of people in their first year of retirement will benefit from, again, tax planning, because it's a whole new ballgame for them this year. They might not know what 90% of their current year tax is without doing some tax planning.
So you'd have to know, all right, what is let's say you're now collecting Social Security. What does that look like per month? If you're getting a pension, what does that look like? And then you'd have to make a general guess, I guess, about how much of your retirement account you might withdraw for the year.
Yep, exactly. And that's where your accountant or us or, whoever, we can help with putting together those figures and calculating the tax ahead of time, so you know what that tax is going to look like for you this year.
Let's just say you did that and then you had an unexpected expense, or you wanted to take out more and you took out an extra $50,000 from your IRA. Could you have tax withheld on that? Would that help to satisfy that? Yep,
absolutely. And that's one of the things that we do with clients towards the end of the year, especially November, December. Some people just wait to the end of the year to take their RMD at all. So they might say, hey, Laura, I need to take my RMD. How much should I withhold based on these other facts? Right at the end of the year, we can run some figures for them and say, all right, in order to cover you from the underpayment penalty, withhold $15,000 from federal and $5,000 from Connecticut. So we'll be able to calculate those for clients so they know how much to withhold.
Okay. So we're both located in Connecticut. We have listeners from other states. Unfortunately, Connecticut has income tax. Does Connecticut have a penalty if you don't pay a certain amount?
Yeah, there's also the $1,000 rule. They tack on some interest. So the specifics, I'd have to kind of look into, but the $1,000 is typically the rule as well. So if you owe more than $1,000, they typically add on a little penalty and a little interest.
Okay. So it sounds like either you're having tax withheld on your money in retirement, or you're paying estimated taxes to cover that. Those are the two ways to try to avoid that interest penalty. Yep. Okay. And if somebody does have to do estimated taxes, like some people do use a tax professional like yourself, but if somebody's doing it themselves, like how do they set that up?
The estimated taxes?
The quarterly estimate,
Yep. So again, it would be triggered by their prior year tax typically. So that also is based on AGI. So typically you want to aim for your prior year tax, and then that would get divided. So if your prior year tax is $12,000,
Sure.
You'll want to divide that up into the 4 quarters. However, if your AGI in the prior year was over 150,000, you actually need to pay in 110% of your prior year tax. Yep. So you'd want to pay in 110% of the 12,000, and then you divide that up by each quarter in the following year.
Yeah.
Yep.
What are the due dates? April 15th?
April 15th, June 15th, September 15th, and then January 15th of the following year is Q4.
So what about like people maybe that overpay? Do you think that's a good idea to just pay a lot so you don't owe? Because some people have that fear, I'm going to owe the IRS. I'm going to go be in big trouble if I owe them money.
Yeah. So for me personally, I aim for the break even. I think that's ideal. So by overpaying the government, you're giving the government an interest-free loan that doesn't get you any brownie points. You can have your money elsewhere. So again, break even is kind of what we aim for. However, you need to really know your clients and how they budget. So, if I know I have a client that's going to owe money every year, and I know that they typically don't put it aside or they don't budget properly, I might recommend that they withhold additional amount or pay a little bit extra in their estimated payment just to give them a little bit of a cushion. Because remember, you might still owe a bunch of money at tax time, but you still covered your prior year tax. So you don't owe a penalty, but you still owe $30,000 at tax time. So again, you got to kind of know your client. So they might have a little bit of an overpayment, which then we could apply to the following year, or we can have it refunded. So it really depends. I hate to keep saying it depends, but everybody's so different. But it really does depend, and you need to know what works best for your client. Ideally, we don't want to just give the government an interest-free loan and say, oh yeah, I'm going to overpay by $50,000. That would not be ideal.
Yes, because even though they want their 3%, they're not going to give you 3% for your loan.
Nope.
Would be nice if they did, but
exactly.
Yeah. What about, are there any additional deductions that someone might qualify for when they retire?
So unfortunately, there's no real deductions per se, just because of retirement. However, one of the things that we do, if we have a philanthropic client, we might try to maximize their charitable contributions by flip-flopping year to year between the standard and the itemized deduction. So, we're working with a very high standard deduction these days. It's over $25,000 for married couples.
Yep.
So what we might do in tax planning is recommend the client make all their charitable deductions in 1 year, take the itemized deductions, and then the following year, minimize their charitable deductions and just take the standard. So we might flip-flop back and forth. So, do it all in 1 year. The next year, you don't do any, and then flip-flop. So that's one of the strategies we use. On the state side, so Connecticut and other states also offer deductions on retirement income. So for instance, Connecticut allows a subtraction modification of 50% of the income received for the state teacher's retirement system. So if you are a retired teacher, 50% of that income gets deducted on the Connecticut side, which is nice. There's also a subtraction modification for pensions and annuity income of 28% on any pension or annuity income. And then, of course, in addition, Connecticut allows you to exclude Social Security benefits when calculating Connecticut tax. So on the state side, and that's just Connecticut, but I know other states have similar things that they may or may not do, but Connecticut gives you a little bit of a break. Is
that age-based, those deductions? Or like you said on the annuity income?
Yeah, actually it's not. So actually, it's not, so if you're, over 55, you don't have to be 70 and a half or 72. As soon as you're a retired teacher and you start getting your pension, that kicks in right away. Okay. Now, do the IRA distributions, are those considered annuity income? So actually many of them are. And there might be income thresholds on it. So the rules change every year. I think it might be 100,000 of gross income in order to qualify. But any kind of retirement distribution qualifies. Okay. Yeah, I know some states don't tax your pensions at all. Yep. I have some clients that retired in Delaware, and there are certain things like that some states do offer. Yep. Some are definitely more favorable than others. Yeah. So while we're on that topic, something I've talked about in past episodes is maybe, some people have this desire already. They want to relocate to a different state from the Northeast because of the climate or whatever. Part of it's because of the taxes, right? Yep. What if somebody is looking to change their residency from Connecticut to another state that maybe has no state income tax, like Florida? How does someone go about doing that? Yeah. And I actually get clients all the time asking this. And, a lot of our clients own property in Florida. So, they say, I just want to make that my residence. Can I just make it my residence? Well, they could, and that's fine as long as they legitimately change their residency. So what I mean by that is that they actually move there and stay out of Connecticut for more than 183 days out of the year. So, they might ask, well, how does Connecticut know I'm here? Can I just change it? Well, they do have checks and balances, whether it's cell phone towers, tolls, your affiliations, your church. So what I say to clients, if you're thinking of making this move, some things you'll want to immediately change: your voting registration, your driver's license, any affiliations, your doctors, memberships, churches, and, stay out of Connecticut for more than 183 days. So it is something to do. Just do it legitimately.
What about like your car registration? You have to register your car in that state too?
Yep, that's always definitely a good thing to do. If you're moving out of Connecticut, I would get any kind of property, especially like cars, out of registration of Connecticut and get them registered in Florida, which I believe you have to have your driver's license in Florida.
To do that, that's the first step. Yeah. Yeah. I mean, it is a big savings, right? I mean, our state income tax starts at what, 5%?
Yeah, and up to 6.99. Yep.
Yeah. So if let's just say 6%, you're making $100,000 of retirement income. Assume all of it was subject to Connecticut. I mean, that's $6,000 goes right in your pocket, right?
Yep.
And then we have our sales tax as well. Like if you go to buy a new car, the car is subject to sales tax. So
just keep tacking it on.
So, yeah, it is great. There's a lot of benefits to live here, but it is expensive.
Absolutely.
Yeah. Are there any like pitfalls to look out for? Like when someone's doing that? I mean, it sounds like you got to be legitimate. You don't want to try to cheat the system because they're going to find out if you do. I mean,
yep. That's exactly what I would say is just make sure you do it legitimately. Don't just assume Connecticut has if you have a condo down in Florida and you're going back and forth half the year, don't just assume Connecticut won't find out. I mean, it's easy now. Everything's electronic. You have tolls, you have plane tickets, you have all sorts of things. So just do it legitimately.
Yeah. Will they look at your credit card transactions as well?
Absolutely. Yep. There's no, and again, I've only had this happen 1 or 2 times in the 17 years, but things as they're progressing electronically going into 2022 here, there's a lot more. It's a lot easier to be caught, especially if you're using credit cards up here. So you don't know what they'll ask for. I had a client where they asked for cell phone records and they all pinged right here. So kind of hard to avoid.
Yes, definitely. Yeah. Yeah. All right. Awesome. So anything else you want to mention before we wrap up here today?
I'm happy to, if anybody has questions or they're looking to change accountants and whatnot, I would say if your accountant, especially going into retirement, does not offer tax planning, to change accountants. It's a very critical piece of what we do. So I would just keep pushing the tax planning, and I'm, always available. We have clients all over the world, actually. So, we'll work with anyone, anywhere. Okay, awesome. And so if someone wants to reach out to you, how would they do that? Yeah, so you could call the office. The number's 203-248-8600, or they can shoot me an email, which is Laura, Laura, @ccotax.com. Okay. All right, awesome. We'll put a link to that information in the show notes if people want to locate that. So thanks so much, Laura, for coming on. And I just want to remind everyone that if you're enjoying this podcast, if you can leave a review by going to Apple Podcasts, that'd be greatly appreciated. Have a great week, and we'll talk to you next Wednesday.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.